In this episode of the Seatrade Maritime Podcast, we'll be talking to Daniel Richards from Maritime Strategies International about the outlook for the container shipping market in the second half of 2025. I'd like to welcome Daniel back to the podcast.
Thank you for having us back on, Marcus.
Great to have you, and I really appreciate the time you take to sort of go through the markets with our listeners. Now, could you give our listeners an overview of the container shipping market over the last 6 months?
Yes, of course. I mean, there's never a dull moment at the moment as a container market analyst. I think if I was to frame what's happened over the past 6 months, going into the year, there were, I guess, two broad sources of uncertainty and one more or less certainty that the industry was facing. The uncertainties were around what Trump would do with tariffs, which wasn't really clear at the start of the year. The next block was around the Middle East, the Red Sea, and the potential timing of carriers going back through the Red Sea. And the source of certainty was that the fleet was going to continue to expand at a pretty heady pace. In practice, what's happened is that the tariff situation has been incredibly volatile. There's been no real change to the status quo in the Red Sea, and fleet growth has been pretty elevated as expected. Now, I think if we translate that to how markets have performed, in many respects, it's actually been more stable and a kind of a less volatile year than 2024 was. And I think you can probably break the market, at least the freight markets, into two buckets. The first being the US import trades, in particular the Trans-Pacific, and then pretty much all other routes. If you look at all the other routes, in a sense, it's actually been more of a return to normality in terms of seasonal trends, in that the spot markets probably started the year quite strong in the run-up to Lunar New Year, but then along pretty normal seasonal lines, markets weakened quite a lot sequentially from January, February through to April and May, and that was across the Asia to Europe trade, some of the trades into Latin America, into the Middle East. But what we've seen in the past month or so is that, in line with pretty normal seasonal trends, plus port congestion in Europe, freight markets on those routes have started to increase again. So while there's been a lot of macroeconomic, geopolitical volatility, a lot of individual container trades have actually performed as you would normally expect them to from a seasonal perspective, with the exception of the US, where there's been more of a roller coaster in relation to the timing of Trump's tariff announcements, reversals, legal injunctions, and all the whipsawing you're seeing of trade coming in and out of the US. I think it's also broadly worth noting is that, the engine of liner company profitability or lack thereof is wider average dollar per TEU pricing. And there, if you look at rates in Q1, they were down around 5% versus Q4, up around 7% year over year. And Q2 is probably going to see either a pretty stable picture compared to Q1 or perhaps even below that level. So, there has been this volatility on the US trades. Spot markets have picked up as we get into peak season, but it is overall still a relatively subdued market. And you can begin to see the fact that oversupply is having an impact just beyond the sort of volatility on individual trades.
Probably one thing I wasn't expecting you to say there was the sort of a return to normality, which is actually quite interesting. And let's say some of what you said there and sort of break it down into bits and go through those in terms of where we're headed in the coming months. Now, obviously, you mentioned Trump's tariffs and the sort of on-off nature of that. How do you see that impacting the market as we go through the remainder of the year?
Yeah, I mean, I'd caveat saying it's a return to normality with the likelihood that something will come along in the next 6 months to upturn that statement. But it was more that, you saw a weakening of markets as you would not often have over the first 5 months of the year, then a strengthening as we go into peak season. But as we're going into the second half of the year, yes, I mean, the tariff situation is certainly going to weigh on the US trades. We've seen US-bound freight rates come off quite sharply in the past month or so, and all else equal, that seems likely to continue over the second half of this year. The status quo of the tariffs is that for trading partners who aren't China, you've got 10% tariffs in place on top of what was in place at the end of last year. That is due to continue for select economies until the 1st of August, where Trump has now unveiled a new set of reciprocal tariffs that would apparently come into place on the 1st of August. They look a lot like the list of tariffs that was unveiled in the Rose Garden on Liberation Day on the 2nd of April. Who knows whether those are going to come into force or whether the can will be kicked down the road again. With China, you currently have, relative to the end 2024 position, additional 20% universal tariffs. Those were the tariffs related to the fentanyl and border crisis that came in Q1. Those have remained in place. On top of that, you've got the 10% additional tariff. And if there isn't a deal with China in place by around the middle of August, that 10% uplift will go to 34%, leaving things about 55% above the N22 status quo. So it's a less dangerous situation than it was in that first sort of mad week of April after the Liberation Day announcements. But it is, I think, worth taking stock of the fact that average tariffs are going to be much higher than they were at the end of last year. So far, that hasn't filtered through much to overall trade growth. I think container trade volumes are in the region of around 4 to 6% up year over year so far this year. And I think with the US, though, that trade position is going to deteriorate in the second half of the year. It's hard to put a precise estimate on how much has been front-loaded into the US. There's kind of ambiguous evidence from inventories and inventories to sales ratios. But it is likely that US container trade imports are going to contract on a year-over-year basis in the second half of this year, with some weakness filtering through to the start of next year at least. And that's likely to drive rates downwards simply because the fleet keeps growing and liners are beginning to show signs of struggling of where to put all these large ships that are coming into the fleet.
Yeah, we have seen that sort of thing with people putting really, 24,000 TEU ships into West Africa, haven't we? Now, I'm going to ask you about something that I think if I'd asked you this question a week ago, I'd probably got a very different answer, and that was the potential return to the Red Sea, but that would now, I presume, be delayed.
That seems very likely. Yes, if you'd asked this 1 to 2 weeks ago, I think the state you've said something to the effect of, well, there haven't been any attacks since the end of 2024. You're starting to see CMA CGM widen the number of services they're potentially looking to put back through the Red Sea. But that's clearly now being put on hold indefinitely. And there's no real prospect of a return to those sailings anytime soon. And we'll just have to wait and see about how that plays out. But yeah, it's a return to a very dangerous situation in that part of the world, and one that doesn't look like it'll be resolved in the immediate term. And I guess we'll have to see how does the US respond again to this upswing in attacks. Clearly, there's reports that the scale of the US bombardment of Yemen earlier in the year was what drove the Houthis to come to the table and agree a ceasefire. We'll see if that dynamic recurs. But yeah, for the moment, the liner companies are not going to be resuming sailings anytime soon.
Okay. That would seem very sensible. That presumably would have something of a positive impact on the demand-supply outlook. Can you kind of give us a bit of colour on the whole sort of the order book and demand and supply going forward?
Yeah, so the order book in particular remains large. Liner companies have continued to place new orders at a very healthy clip. We're up to around 2 million TEU of new orders placed so far this year. And that's really meant that the order book fleet ratio has remained stuck at just over 30% of the fleet, still very heavily weighted towards larger vessel segments, but there has been an uptick in ordering of smaller vessels, which is very overdue given the age profile of that fleet that we've seen in recent months. The overall picture is that without the Red Sea diversions, you'd have like an aggravated problem of allocating and finding uses for all the ships hitting the water, and it is one factor that continues to prop the markets up. We think that over a full-year basis this year, global container trade growth is probably going to come in at around 3.5% to 4%. The fleet is likely to grow by around 6.5%. What's coming forward is that we think that's going to weaken going into next year, in particular driven by the US. There's also a question of how long China can continue to export its surplus of manufactured goods to external trading partners without those piling up into inventories or inviting retaliatory trade measures from countries apart from the US. The global economy remains relatively stable, is likely to slow somewhat. So the trade outlook as we move into next year is likely to weaken, but outside of the US is unlikely to be catastrophic. There will also be a slowing of fleet growth as we move into next year, just because of the structure of the order book and the delivery schedule. But the overall point, again, is that fleet growth will substantially reaccelerate as we move beyond 2026, as orders placed in the past 18 months or so begin to leave the yard. So there's likely to be a weakening of demand-supply balance as we move into the second half of this year. We think it's one that will weigh on average freight rates as we move beyond peak season. There will be something of a respite on the supply side, but the accumulated volume of vessels that have hit the water over the past several years is going to be there in the background. And even if there's no resolution to the Red Sea crisis, it is still an industry facing potential oversupply, and we think will face actual oversupply in practice, well, at least until the next thing comes along.
Okay, so eventually sort of oversupply is just unavoidable for the sector, really.
It feels that way, but the sector has managed to avoid the worst consequences of that to a very surprising extent so far.
Indeed. So yeah, there's been a lot going on in container shipping, and is something we'll be covering ourselves as the year moves on.